Invest in equities. Well, here to talk with me about that is Brian Regan. He's a senior portfolio manager at Wealth Enhancement Group, and he has 10 thoughts to share about that topic. Brian, welcome.
Hi, Bob. Thanks for having me as usual.
Oh, it's a pleasure, and we're eager to have you share your 10 thoughts on how to invest in equities with us. Where to begin?
We might as well start at the top, right? The first thought, which I think is the first and most important thing for any kind of investing strategy, is have a long time horizon. I say it often, and sometimes it falls on deaf ears, so I think it's always worth repeating. The longer time horizon you have, the greater chance you're going to have for success. And I'd add that most people have a much longer time horizon than they think they do. Even if you have a terminal illness, it's likely that you're investing for the next generation. So from that context, have a long-term time horizon. Don't worry about things in the short term, especially when it comes to individual stocks. Individual stocks can be very, very volatile with an average standard deviation of around 20% for the market. So that's going to be much higher for your average stock. Be comfortable with the natural volatility that's going to happen over a 12-month period. A lot of times it's pure luck, bad luck, or good luck. And it takes time for a business to, use its cash flows to improve the business, and it pays to be patient.
Yeah. I often think, Brian, that investing is a long-term sort of venture. Speculating might be a short-term venture, but investing is different, entirely different.
Yeah, I don't really understand speculating. I mean, we've talked about that in the past, and almost everything I write is about investing, not speculating. So that's a great point. To that point, this article is about trying to outperform from an investing standpoint, not from a speculative standpoint. So, when I evaluate how I think I'm doing, I compare myself to whatever benchmark I'm using over 3 and 5 years. I very, very rarely, are interested in year-to-date or one-year numbers because, it's just less important to me.
Yeah. What about number two on your list?
Yeah, so I think that leads us into number two, right? If we are investing in stocks, and you're trying to outperform, what are some ways that you can do it? Well, you could be more concentrated. So, in our individual stock discretionary portfolios, I like to only hold about 30 stocks in the portfolio, give or take a few. That's significantly less than the S&P 500 or the Russell 1000 or Russell 2000 or Russell 3000, right? So. Why do I think that provides enough diversification? Well, if you actually look at the S&P 500, for example, there's 500 stocks in it, but 483 of them have an allocation of less than 1%. So how much are they really driving the bus? On average, those top 17 stocks or even the top few stocks are the ones driving. So you can ask yourself, even if you're in the index, how diversified am I really? Now, if you're going to pick 30 stocks, give or take, you're going to have a higher allocation on average, right? Your lowest stock on average, you're going to have about a 3% allocation per stock, right? A little bit more than that. The good thing about that is you can be more discerning. You're going to have a better odds of choosing a stock that's going to outperform, and I think there's a lot of benefit to that. That number three is expand your investment universe. If you're benchmarked against the S&P 500 and you're buying 30 stocks, you don't have to just buy stocks that are in the S&P 500. The S&P 500 is mostly large cap domestic stocks. You can buy an international stock. It's true that international stocks have lagged, but we're buying stocks here. We're not buying entire markets. So there's nothing stopping you from buying the best stock that happen to be domiciled outside of the country. There's plenty of great ones in Europe and elsewhere. So. We're talking about building a diversified portfolio of 30 of the best stocks we can find, not 30 of stocks within a benchmark universe.
Yeah. So when you think about the S&P 500 and it being largely large cap, you mentioned the Russell 2000, the Russell, there are other indices where there are much smaller stocks, smaller mid cap or small cap stocks. So I take it that when you're expanding your investment universe, you're thinking not just large cap, but mid cap and small cap as well.
Yeah, I mean, I own a few small cap stocks. I think you got to size them appropriately. You might not want to hold, a small cap stock or a bunch of small cap stocks with a huge percentage. But if you find a small cap stock that you think is going to grow into a large cap stock, there should be nothing, in my opinion, stopping you from investing that. We're not bound by any rules here in our discretionary 30 stock portfolio.
Right. What about number four?
So, ultimately, we're looking at a larger investment universe. We're trying to find the best companies. How do you find the best companies? Bob, I think me and you have talked about this before. For me, it's about consistency and growth. It's very, very hard to value a company that is not consistent because you just don't know what kind of cash flows they're going to have very far out into the future. It's a guessing game. You can eliminate a lot of the guessing game by finding companies that are consistent over time, that have been around for a long time, that have produced similar results, that have had management that's been around for a long time. I'll give you an example. Nike just hired a new CEO. He started with the company as an intern. That is the kind of consistency that I love. He's been with the company his entire life. That's something that's exciting. Costco has recently turned over its CEO. He started with the company as a forklift operator. So those are the type of consistent themes that I'm looking for: consistency in the business model, consistency in the management, consistency at upholding the ideals of the company, and then ultimately growth. We want to see them be able to charge through revenues well into the future at a sustained clip. We pay pretty high multiples for these, so in order for the math to work over time, again, a longer time horizon than 1 year, you want to see some growth to make that math work and make those returns attractive. So we're concentrating on companies that are consistent in growth. And as we go through these, you might realize there's a theme here where I'm weeding out things that aren't consistent or don't have growth.
Yeah. Right. So as you're talking about paying, not being afraid to pay higher multiples for cash flow, I'm sometimes reminded of, I think it was Peter Lynch who was famous for making the PEG ratio a common nomenclature. Is that something that you're fond of, using the the PEG ratio in these cases, or not?
Well, I like the idea of the PEG ratio, the sentiment, if you will. I'm not big into hard and fast rules. I think you will pay a premium for consistency normally. I think you will pay a premium for growth normally, and you'll probably pay a premium for consistency and growth under normal circumstances. Now, the best possible situation would be to find consistency with growth at a very attractive valuation. That's the home run, right? Because you can be confident that the stock is depressed for reasons beyond the fundamentals of the business, and that's the perfect buying opportunity, in my opinion.
Yeah. So a lot of investors are attracted to dividend strategies. You have a thought on that as well?
Yeah, I mean, I often critique people who are dogmatic about their income in their portfolio, their dividend. If you compare a dividend strategy to any other kind of index or strategy, you'll see that it typically lags. And the reason for that is there's 4 different things that you can do with your cash. You can reinvest in the business, you can pay down debt, you can buy back stock, and you can pay a dividend. If you're going to get growth, you need to reinvest in the business, right? So you're probably not getting as much growth if you have a high dividend. They can often be more indebted companies because they're choosing not to pay down debt. They're choosing to pay a higher dividend. Buying back stock is more tax efficient. In capital gains, taxes are more tax efficient than dividends. So these are things that are worth considering. That if you have a high dividend yield, you might be leaving something on the table. The thing that I don't say here is that you have to reinvest the dividend too. So if there is a big change, if there is a big price change, for example, and the dividend yield comes down, and you want to sell the stock, you have to reinvest that stock, and you have to reinvest the dividend. So your options might become very limited. Now, if this is something that you want to pursue and you still want to try to outperform, I'm not against dividends. I mean, of course, I like cash flow, right, above all things. So you want to look for what I consider unicorns. Maybe unicorns isn't quite the right word because they exist more often than you would think, but they're rare. And you want to look for something that has a very, very high dividend. I say, as a rule of thumb, 3 times more than the market. And you want to understand why it pays a high dividend. Why is the stock depressed? And you want to make sure that dividend's covered. If you think that the dividend is covered and you know why the stock is depressed, and you might be able to get a rally in the stock price while collecting that nice big dividend. So, the article is very clear on this. I'm not completely against it. It's just hard to find. It's hard to build out a portfolio of these types of stocks.
Yeah. Is it more often the case than not that some of these dividend paying stocks are also value stocks versus, say, growth stocks, or is that incorrect?
Yeah, I guess it is. I mean, that's the reason why the stock isn't moving, right? Because they're not expected to grow very much in the future. I'd say that's one of the negative, connotations of it. But it's not always the case, right? Sometimes you might just have to wait 2 or 3 years for the growth to pick up. They might have a bigger, idea in the pipeline. I'll give you an example, and this is none of this is financial advice, by the way. But I'll give you an example that Pfizer pays a very attractive dividend right now. There's an activist in the stock. The idea is that they are not growing. They don't have anything that immediately that's going to grow earnings. Now that might be true in the near term, but they did use a lot of the proceeds from the COVID windfall that they had through the vaccine and Paxlovid to buy Seattle Genetics or CGen. And that is a very attractive pipeline of cancer drugs. Now they're not expected to come out in the next year, probably not in 2025, but maybe you start seeing that revenue come in 2026. So that's something that you might want to collect the dividend and wait for the realization of that technology in the future.
Yeah. So we're often reminded that 2/3 of U.S. GDP is driven by consumer spending. What do we need to know about that?
So to that point, I think you're going to have retailers in your portfolio. If you're going to have a diversified portfolio of 30 stocks, you're probably going to have more than one retailer. And we have over here at Wealth Enhancement Group, we have common discussions about certain retailers we like and dislike. And you can imagine that a lot of the brands that everybody knows and loves get discussed often. And one of the things that I've noticed over time is that great stocks can be low cost, they can be luxury. But if you're both, you're going to end up being a cyclical company. So if you are trying to sell high margin items through a broad-based consumer, what you're going to do is get stuck with a lot of inventory, do a lot of discounting, and you're going to have you're not going to have any consistency, right? You're going to have margins that move up and down. You're going to have sales that move up and down. You're going to have foot traffic they're not quite sure what you're selling, right? And this is pretty common. So what I like to do is focus on one or the other. Oftentimes you find if you concentrate on low cost, broad-based brands, they can sometimes upsell discretionary items, and they have a lot of consistency in their revenues, in their margins, and their growth. Now at the same time with luxury brands, they might have shortages of something, which is a problem for a broad-based company, but it could be a good thing. It could make luxury items more appealing to people and willing to pay up more and make it even more high margin products, especially with a clientele that's economically insensitive. So I make sure you're at one end of the spectrum or the other, and if your retailer is kind of sitting in the middle and they're unclear in the direction and the strategy of their business, I'd be careful with that one.
Yeah. So number 7 on your list is cyclical stocks, and I know people are familiar with the term, but may not understand what to do with cyclical stocks. What's your thought?
Generally, I try to avoid them, and that has a lot to do with what I was just telling about retailers, right? I was really saying avoid cyclical retailers, right? Try to find consistent retailers. This all comes down to consistency and growth, really. And cyclical companies are not consistent, almost by definition, right? They are going to go up and down with the economy. So the problem with cyclical stocks is when they're going up, when they're hot, people love them, right? I say when the bullhorn comes out, put on your earmuffs because people are going to love them. They're going to talk about them on CNBC every single day.
Yeah.
The problem is when they fall from grace quickly and hard. And it can be hard to let go of a company that you just saw do really, really well, and you might see your gains give up. So, how do you recognize a cyclical company? And I give a few rules of thumb. If it's a commodity that multiple firms can create, copy, or dig out of the ground, it's probably a cyclical stock. If it's manufactured hardware that could be re-engineered, relying on third-party software or open source, it could probably be re-engineered. The big one with that, I get reminded of the case study of Microsoft, right? They licensed their content or their software to IBM for almost nothing. They got on every single piece of PC hardware at the beginning of the PC boom. But what IBM did is they didn't hold Microsoft to being the standard on an IBM computer. So Microsoft then went ahead and licensed their software to every computer manufacturer, including Gateway and Compaq, and they became ubiquitous. While IBM has clearly not kept up with Microsoft over that time. So in that case, the manufacturer hardware was the cyclical industry. The capital expenditures are close to or exceed the operating cash flow in any year. This is I get reminded of steel companies when I see something like this. You might see U.S. Steel with a PE ratio of 1. That might be super attractive, right? But what the market's basically telling you is they're expected to lose money at some point, very soon. Or we talk about GM and why is it so cheap? Why is it trading at 5 times earnings? Well, their capital expenditures, their retooling, their investments exceed their operating cash flow in any given year. So there's nothing left over for shareholders at the end of the day, and that's why the stock's trading very cheaply. Sometimes, particularly with pharma companies, they're relying on patents, and patents expire. And you need to keep that in mind, and that can cause a big whiplash in stocks that, for all intents and purposes, seem consistent otherwise.
Yeah. So number 8 on your list is to ignore style boxes, and oftentimes people are, if they go to Morningstar or other places, they might notice that things are labeled as large cap value or large cap growth or small cap value, small cap growth or mid cap core or whatever the case may be, and those you think should be ignored.
Yeah, so I think these style boxes were made with the best of intentions. I think they were designed to help people diversify in a very simplistic way, to make sure you're not overly heavily influenced by one type of factor, if you will. But if you're trying to outperform, we want to do something out of the norm that everybody's doing, right? We want to take the next step and evaluate companies and find out what's really a growth stock, what's really a value stock. And the problem with these style boxes is they can be very, very misleading. So they tend to only be based on the price to earnings ratio, which I've written an article previously on for you, Bob, that discusses the many problems with the PE ratio. So I'll give you an example. If a PE ratio is low relative to the market, it's typically considered a value stock, right? That value stock might have a lot of debt. That makes it inherently riskier. It might have declining revenues, declining profits. To me, that's not necessarily that's a sinking ship. That's not a value in any sense of the word. Well, a growth stock, it might have a high PE ratio, but it might be very consistent. There's a lot of consumer staples that might be placed into the growth box just because it has a high PE ratio. It doesn't mean that it's growing very fast. It just means it's a very consistent stock, and then investors are willing to pay up for that consistency. Now, there might be stocks that are historically fast growers that, for whatever reason, right now aren't necessarily growing very fast, and then this really confusing thing happens where they could be placed in growth indices and value indices. So what I'm saying here is let's not evaluate stocks based on this simplistic formula, right? Let's think about what's really going on with the business model. Is it expected to have growth into the future? Is it expected to have consistent growth into the future? And let's build a portfolio of diversified stocks that are consistent and growing. If we can get them at a good price, all the better. But this connotation of value, growth, and blend, I don't think is necessarily helping people outperform.
Yeah. So oftentimes, I mentioned Morningstar a second ago. When people are going to do research on possibly investing in this or that stock, they might go to Morningstar or Bloomberg or FactSet. What's your thought about that exercise?
I think it's a fine starting point. I think for a lot of people, it's the end point, though. They might look at the PE ratio, and they might look at, the brand name, or hear some talking head talk about it on TV, and that's how they make their decision. I think that's just the beginning. That might be a generation source for ideas, which is fine. But I like to go to the source files. And what do I think the source files? I think it's earnings calls, and there's transcripts for those now. I think it's the 10Ks and 10Qs. There's tons of information in there that might give you an idea of whether this is really a consistent company or if it has inherent flaws. I wrote that back when I was a turnaround consultant working for failing companies, I learned a lot about how companies can fail pretty rapidly, right? They can go from a really high growth to a really high failure pretty quickly, and there's some good reasons for that. One is indebtedness and maturities coming that they have to refinance. Another one might be, they're concentrated in clients. Maybe they have one or two big clients, and things are great when those one or two big clients are there. But if they lose one of those clients, then they might be out of business, might not be able to service their debt. So these risks are often found in a lot of these source files, right? And reports from the company that are both mandated in the management discussion and analysis part of the 10K and 10Q. But also they might talk about it in their conference calls. Analysts might bring it up. I was listening to a conference call yesterday where this company has a lot of cash on their balance sheet, and I would just want to know what they're planning on doing with it. And I was unsatisfied with the plan on what they're going to do with it. So, that is something that you're not going to find from a screen. You have to go digging and find out what their plan for the future use of this cash is. And that's very helpful in determining what you think is a good stock for you now and in the future.
Yeah. In terms of gathering information, number 10 on your list is also sort of in that same vein, I suspect, yes?
Number 10 is all about, why. I think we all need to ask ourselves, how come active management hasn't been working in this industry? And it's not because it's not possible. I believe it's possible. I have seen it been done. I ask myself, what are the impediments? And I think a lot of the impediments are a lot of bureaucracy and maybe a lack of diversity of thought. So, why make the example of, personally, my formative years are very dominated by the dot-com bust and the great financial crisis. There's folks older than me in the industry who might heavily be influenced by the inflation of the 1970s, and this recent, spike in inflation might have caused certain biases, to make them feel like that was going to happen again. And if you're a younger person, you might have really nothing but optimism, right? That's kind of all you've seen over recent times. And my I guess what I'm preaching here is, let's get all these people in a room. Whether it's me and an older person and a younger person, or, just my point is different people with different ideas and different biases. And I think if you have that discussion, you're more likely to get to consistency and growth rather than having three people who tend to agree a lot on the same failing ideas that haven't been working over a long time period. It's really just an encouragement of recognizing we have bias, finding ways around it, finding ways to find where to be optimistic for the future.
Yeah. So, Brian, this has been a masterclass in how to invest in equities, and someone who might listen to this or read the article that you wrote for Retirement Daily might say, hey, this eliminates my whole portfolio.
Yeah, I mean, I was going through it, and I wrote that in the conclusion. Hey, this might eliminate your entire portfolio, and I guess you're welcome, right? Because this isn't supposed to be easy, and you're supposed to be very picky about what you put in your portfolio. This is your hard-earned money, or your client's hard-earned money, and we want to make sure that we protect it, and we also want to make sure that we make the gains that these companies are generating. We need to be discerning and do the work. Just beyond screens and beyond just talking to people who agree with us, but doing the hard work of actually reading the things that nobody wants to read and talking to people who might disagree with it. My message here is, let's continue to do the hard work to find the right things for your portfolio.
Yeah. Brian, it's always such a pleasure to chat with you and, have you share your unique perspective on things. So I greatly appreciate it. Thank you.